I'm doing great, Amy. How are you doing?
I'm good. I'm good. Here we are, the beginning of November, and it's finally looking like fall outside, isn't it?
Oh man, I love a wooded lot until October, November.
Yeah, exactly.
It's
I'm not,
crazy.
I know. It's like so many leaves and it's so dry outside. It's been
I
quite a
know.
fall for us.
Yes,
Yeah.
quite
Oh,
quite the year.
yes, quite the year. Wow.
Quite
In all matters, right?
yes.
Yes. Well, thank you for joining with me today. Thought we'd jump online, give some updates. There's so much noise. Boy, it's a noisy time of the year when it's an election year, of course, and people get overwhelmed, kind of coming at you with a firing hose. So we kind of want to break down myths, talk
Yeah.
about some solutions that we can provide in the marketplace today. We're in the fall, we're in the fourth quarter. We're easing into the holidays, which tends to be a quieter time of year for us in Minnesota because we're kind of seasonal in our sales.
Yeah.
It gets cold, people tend to want to move less, but that
Hmm.
creates a great opportunity for a buyer. I mean, if you don't care about snow, go for it.
Yeah.
Um, so, um, but we've had some changes just in the economy that are, creating kind of a change in how things are operating in our business. So first thing I wanted to do is just kind of give everybody an update where median price range is. We hit 360 here just last month for median price range in the Twin Cities. So if you're listening from out of the area, it kind of gives you a baseline of median price. We have increased over COVID 10, 12, and 16% each
Mm.
year during COVID. So completely, you know, uh, historic, unrealistic to continue at that pace. So everybody feels comfortable in the 5%. So we'll see what this next year brings, right?
Amy, quick question. As far as median sales price, how does that compare to previous year or previous months this year?
Yeah, exactly. Last year we were at we hit 350 in
Okay.
2021. Because I remember
Yep.
like a big, when you hit that, half quarter like that, I was like, wow, that's pretty amazing.
Yeah.
So
Yeah.
yeah, and like if you want to compare to like 2007 and 8, our median was like 250 to give you a
Mm.
way different
Wow.
perspective. Yeah, so
Wow.
we've climbed far out of the gutter of that value range from back then. So,
Yeah.
yep. So as interest rates are climbing, we've had, of course, the lovely stepchild of inflation. We are starting to see sales starting to slow a bit. In
Yes.
fact, we saw our height in activity in the spring. April was kind of the high point of our market. We climbed for almost 3 years, and that was really the height. We even saw showings decline by 20% in the Twin Cities starting in April.
Hmm.
Okay, so
Hmm.
we started to feel this in the spring, but things were still gangbusters.
Yep.
And now we're starting to feel a slow here with kind of the throttle of interest rates, and people are kind of resetting, we'll say, maybe
Hmm.
their price point, maybe their expectation in the process.
Quite interesting because probably 6 weeks ago, we felt a dramatic decline in mortgage applications.
Hmm.
Year to date, year over year, mortgage applications right now are down 41%. A lot of that is just the unknown in the market, interest
Hmm.
rates being over 7%,
Hmm.
and a lot of buyers, about 33% of the market would be a first time home buyer. And I think a lot of them are taking a pause and, trying to collect themselves and figure out what the heck do we do as we move forward. And yet, I've had a number of clients recently in the last month that have found opportunities on houses that they would not have had this past summer.
Oh yeah, this is the time to jump in for those buyers that got ran over.
Yep.
And I met somebody last weekend. It was random. She told me she'd wrote 12 offers in last year. I'm like, oh goodness. I'm like,
Yes.
it's your time to shine. Yes, buyers, it's time to get off the sideline, or step in, because there's a time here now. There's an opportunity, usually in the fall anyway, to
Hmm.
have maybe a better price on a home, or a seller that is willing to contribute, a seller that's willing to be part of the program, right?
Yes. Yep.
Right now, sellers are kind of coming down, to the back to planet Earth, and having to realize we need to concede, we need to inspect,
Hmm.
we need to
Yeah.
allow for a second showing. I mean,
Yeah.
kind of the ridiculousness we saw the last couple years are kind of going away, thank goodness. because
Yes.
it was different. It was uncomfortable. People still
Mhm.
bought, people still
Yep.
sold, but it was just a different environment.
So stressful. My
Yeah.
gosh, think about all the homes you've shown buyers this past year before they finally found one. This past weekend, I had clients that were looking at a house, and
Hmm.
they had started earlier in the year, lost out on many opportunities. They wanted to go in and put a full price offer in on their house. Their agent said, let's hold off. Let's see what happens over the weekend.
Yep.
The clients are like, yeah, but there's a open house this weekend. And the agent said, let's just pause and hold. They
Hmm.
get through the weekend, no offers. They go in 10,000 below list and asked for seller paid closing costs and got it all. You
Yeah.
know,
Yep.
this again, proof you've got to be working with an agent like
Hmm.
such as yourself in
Hmm.
these transactions because you know where the market is
Yep.
and you'll look out for the best interest of your client.
Yeah, you got a lot. There's a lot of that holding. I did that with a client just this morning. It's like, no, let's hold where we're at because it's the right time to do so. We can do that now. We can kind of wait for that seller to react to the buyer, right?
Yes.
So with
Yes.
that client over the weekend, did they take some of those seller paid closing costs and do any kind of buy down stuff? I'd like
We,
to talk about how the mortgage industry is reacting to rates and trying to make this, give some solutions.
Yes, the most common product that's come out right now is the 2-1 buy down.
Okay.
Now, there's a 3-2-1 buy down, a 2-1 buy down, and a 1-year buy down. What it is there is a fee for this enhancement to your loan. It
Hmm.
has to be paid for by either the sellers or the mortgage company.
Hmm.
So we can do that as a mortgage company. We can raise our rates to pay for part of that. But what happens on the 2-1 buy down, let's say that they lock in at 7%.
Hmm.
Their first year, their payment would be based on 5%.
Okay.
Their second year, it would step up to 6%. So the way this works is the payment reduction is all the interest that's paid on that loan in the first 2 years is this lump sum chunk of money that the seller provides for
Hmm.
closing
Okay.
that will reduce their rate, reduce their payment. As an example, on a $400,000 loan on a
Mhm.
2-1 buy down, the fee that the sellers would pay in closing costs, so it'd be a seller paid closing cost, would be $9,531. The advantage to the buyer is their payment will drop about $400 a month. So
Wow.
now what we have to do
Wow.
is analyze this and look at it. Is it better for the client to take the 9,500, use it towards closing costs, or apply it to the 2-1 buy down? I presented this to two clients. Both have decided to keep the cash
Hmm.
because the other side of the coin is I believe in the next year or so rates are going to come down when inflation's under control.
Yep.
And so you're almost better off take the cash, drop your closing costs, and it would be assumed that within 2 years you'd be able to refinance and drop your payment for the term. But
Mhm.
each transaction stands on its own. I have a
Yeah.
consultation with the client to run the
Mhm.
numbers.
Yep.
I've run it by two clients that had the opportunity. They chose to keep the money.
Yeah. Right. And it depends so much again back to like how long are you going to be in the home? What are your plans? Is this the
Yes.
forever home? Are you here? You relocated for 3 years? There
Yes.
is so many scenarios now. There are so many options. For the last 5 years, all we've been doing is 30-year fixed out the door, right?
Yes. Yes.
Which are great,
Yep.
obviously. You
Which
know.
brings us into the next product possibility. That would be an ARM,
Yeah.
a 5, 7, 10-year ARM. So as those of us that have been in the real estate business a long time, it's typically you have a shorter period of time that your loan is locked. So a 5-year ARM, you're locked into a fixed payment for 5 years. And then after that, it would adjust, it would convert into an adjustable rate, typically changing once or twice a year.
Hmm.
There are certain caps on that. I bought my first house with a 5-year ARM because I knew I wouldn't stay in the house that long. Now,
Hmm.
here's the interesting point. As a mortgage banker, I shop my clients out to about 20 to 25 different investors to get the
Yeah.
best rate, get the best option. We are still at a point where in the conventional world, that's a saleable loan. there are no mortgage companies that are interested in ARMs.
Hmm.
And here's why. The mortgage industry, the pricing is so volatile right now because
Mhm.
all these investors that buy mortgage-backed securities and mortgages from companies, they know that when inflation starts coming down, rates are going to come down and clients are going to refinance.
Yeah.
So all of the ARM investors know that that loan is not going to be on the books that long, and I don't have any options in ARMs that
Hmm.
are better than a 30-year fixed rate, believe it
Right.
or not.
Interesting. Interesting. But people are going to ask because it's a product
Yes,
from, that was very popular 20 years ago that's coming
absolutely.
back, but really the buy downs are a bit more important, maybe more modern
Yeah.
of a solution. Again, everybody's got their own specific situation.
Now here's the
Hmm.
other interesting thing in mortgages. So the typical consumer could kind of keep an eye on the 10-year treasury. The
Mhm.
10-year treasury bill is a financial vehicle that usually is about 200 basis points below a 30-year fixed rate.
Hmm.
And we could look at this historically. If the 10-year was at 1%, 30-year fixed rates would typically be about 3%. So historically, that's typically always been about 2% higher. 30-year fixed rates would be above the 10-year. Right now, that spread is 300 basis points or 3%.
Mm.
Again, the other thing that's telling everyone, the servicing investors know that these loans are going to pay off quickly. If you're buying a mortgage, if you're an investor buying a mortgage, you want that loan on the books for about 6 to 7 years for you to make money on it.
Hmm.
With rates as high as they are, knowing that when inflation comes down, rates will come down, all of these investors are just like, we know it's not going to be on the books that long. If you want to try to get a lower rate, you're going to pay a big upfront fee to lock in on that rate because the investors know it's going to pay off probably within a year or two.
Right.
So
It'd be quick. It's an
our our
opportunity for them.
our, our rate pricing is way out of whack right now.
Hmm.
So to create an interest rate option where you have no points is much more costly today than it would be in a standard normal market.
Hmm.
As the markets stabilize, these options will come back, but right now it's so volatile. Fed Chairman Powell spoke yesterday. The
Hmm.
beginning of the meeting was favorable for the mortgage industry. We saw mortgage bonds being purchased and the
Hmm.
markets going up, which meant rates were going down. In his press conference following that meeting, he kept talking and extending the fact that they're going to be aggressive. They're going to do everything they can. That was not the news that the markets wanted to hear or the mortgage bond market wanted to hear.
Yeah.
And we had a sell-off. And in one day, in the past couple days, we've gone from 7% to 7.25%, just
Hmm.
from the comments of the Fed chairman.
Just impactful, right?
Very volatile. Yeah.
Right?
Yes.
Yes. Yeah. And that's interesting. Like when people put offers on homes and sellers are kind of taking their times, dragging their feet, not reacting quickly, it could cost a buyer a quarter point.
Yes.
So,
Yes.
yeah. So, I mean, sellers just kind of need to be a little bit more Johnny on the spot as they are coming down from, back to planet Earth. Like, you need to react to the offers that you have. It could change tomorrow. If the rate changes, the buyer might be like, God, that's just
Right.
a little bit too much,
I've had
possibly.
that happen. I've
Yeah,
had that
right,
happen.
right.
Yeah.
I
Yep.
just think right now more than ever, I mean, it's always been this way. Everybody, you should know what your comfortable payment is, right?
Yes.
Okay, that's really what you should know. Hey, I'm willing
Yes.
to spend this range on a home every month, right? Because,
Yes.
rate is rate. Home value is home value. When you need to buy or sell, you just have to for whatever your life reason is, and you play within the environment there, right?
Yes. Yep.
So, my anticipation or my not what I expect is that we will see values come down. We have to. It is the counterweight to
Mhm.
interest rates, right?
Yes.
So, someone that was out there looking for that $500,000 home, well, now that mortgage payment has changed. So, what's the counterweight? It's going to have to be price. So, as a seller, hey, is your home worth what it was in 2020 or 2019? Maybe, might be.
Maybe.
Hey, that was a heck of
Yeah.
a value too. We forget
Yes.
how our homes were a great value, pre-pandemic, really, because we've come
Yes.
such a far way out of the recession. So,
Amy, I'm
mhm.
curious, what do you think will happen to values of homes if, let's say, rates get under 6% next year? Will it go the other way potentially?
I think, we already started to see things kind of slow in the spring. People
Hmm.
are the values are high. Values are
Hmm.
high. So there was this buyer fatigue already
Yeah.
setting in.
Yep.
So I do think we will, even if we go back to 6, which probably will, we'll still
Mhm.
see, I think, a value decrease. Maybe,
Okay.
we'll see double digit, maybe up to 10 is
Yeah.
kind of so far is what I think will
Hmm.
happen. So basically, maybe, over the last 3 years, your price of your value of your home has maybe gone up 15 to 20%. Okay.
Yeah.
Well, maybe you lose 5% of that. But again, it was kind of an inflated time
Yes.
in our market, right? I mean, really just some historic things, right?
Yep.
Yeah. As you're starting to see mortgage apps down, we're starting to see pending sales come down about 20%,
Hmm.
reflective of, just this last 3 weeks.
Yeah.
And we're comparing October now to October last year. Okay. Again, fall is a little quiet, but we're seeing about 20% less pending sales. And now sellers are doing more price reductions, right?
Hmm.
They're reacting. They want to get things sold. So we're seeing about 26% of
Mm.
sellers taking price reductions to get it under contract. Again,
Yeah.
kind of level setting that price.
Yep.
So today's market is the buyer that wants the seller to cooperate, that wants to know their that needs to know their payment when they walk into that house, right? They need to know
Yep.
what their interest rate's going to be, what insurance is going to cost,
Mhm.
and they want an inspection. As silly as that sounds, thank gosh that is coming back to our marketplace. For some
Yes.
homes it's maybe not needed, but for the huge majority it is. So
Absolutely.
yeah,
Yep.
not to just to find things wrong and to nickel and dime sellers, to educate. The point of a home inspection is education, right?
Yes.
You find a flaw, sure, but it's not to make a mockery of the seller.
Yeah.
So
Yeah. If you need a new furnace, that's a big ticket item. If you need new
yeah,
windows, big ticket item.
right,
And to the first time home buyer, when you're competing with 40 others and you feel this pressure that you've just got to waive the inspection, what a horrible position you can find yourself in once the
mhm,
dust settles and you're in your house.
right, yeah. There's been some interesting stories that come out of non-inspecting times in our market.
Yeah.
Especially I've heard about so many things in other parts of the country where they deal with a lot of different elements than we do here in Minnesota. Yep.
Hmm.
So, and then on the flip side, I think today's seller is coming, kind of to reality. They're still thinking of values of last year or this spring. But
Hmm.
as reality is setting in, price reductions are becoming more top of mind. And even pre inspecting a home is now something that really was pushed, was a huge part of all of our post pandemic sales. Doing the pre
Hmm.
inspection can really get you through a process a lot quicker. And I'm
Ah,
still seeing that. And if that's still something that I think would be great moving forward, I don't think a seller should be afraid to do a home inspection and make it public. It
yeah.
is it is just a third party's opinion of the property, to help educate. It'll just
Yep.
kind of help streamline the process. And then
Uh-huh.
if there's any little Mickey Mouse things that, you want to fix, then great.
Yes.
So yeah, there's some good things that have come out, and as we're adjusting, I think we're going to see quite a bit of that.
Change is constant, that's for sure.
Oh my God.
Yeah.
Yes, it is. It is.
Yeah.
Well, thank you so much for joining. It is always great to get together and give an update because, wow, things change week to week. I've said this all year. I mean, you have to be in this race every week to understand what is changing because
Yes.
it's different. The environment continues to change. So, if anyone is out there that is curious about the marketplace, what's going on with buyers or sellers in the Twin Cities, we would love a chance to chat. Brian and I, our team, we've been working together for years, and we've learned a lot together. So I appreciate it.
Yes. Love it. Love it. Yeah. Thanks so much, Amy. You have a wonderful day.
Thanks. Bye.
Okay. Bye.